We're analyzing Procter Gamble, stock ticker PG, to see if this great business is on sale. This analysis is just over 10 minutes. It's going to be intense, but it's going to be worth it. We're using the Select 6 analysis to look at the most telling financial metrics before estimating a fair value for Procter Gamble. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing Procter & Gamble for your stock portfolio. Before we get into these valuable metrics, let's understand Procter & Gamble's stock performance. Right now, Procter & Gamble trades for $151.99 per share. Year to date, their stock price is up just 0.5%. Procter & Gamble currently trades 7% below its all-time highs. In the last 5 years, Procter & Gamble is compounding at 14% annually. In the last 10 years, they're compounding at 6.5% annually. Going back prior to the global financial crisis, in the last 18.5 years, Procter & Gamble is compounding at about 6% annually. Keep in mind the company is a dividend king. Procter & Gamble has paid dividends for each of the past 132 years. They've grown their dividends in each of the past 66 years. This gives them one of the best all-time dividend track records. Right now, they pay an above-average 2.42% dividend yield. Their average dividend yield in the last 2 decades is in addition to these returns in their stock price. Procter & Gamble trades just $6 below their all-time highs. The company's up $30 from their 52-week lows. About 0.5% of their shares are sold short. Procter & Gamble is a huge business. They have a $359 billion market cap. But the burning question is, why should we be paying close attention to Procter & Gamble? Since its founding in 1837, Procter & Gamble has become one of the world's largest consumer product manufacturers, generating more than $80 billion in annual sales. It operates with a lineup of leading brands, including more than 20 brands that generate north of $1 billion each in annual global sales. These include Tide laundry detergent, Charmin toilet paper, Pantene shampoo, and Pampers diapers. Procter & Gamble sold its last remaining food brand, Pringles, to Kellogg in calendar 2012. Sales outside of the United States represent about 55% of the firm's total sales, with around 1/3 coming from emerging markets. Now that we have this background, let's get into the numbers. Starting with metric number 1, we want Procter & Gamble's average return on capital in the last 5 years to be above 14%. The average business earns about 7% returns on capital. Looking for a benchmark that's double this can build in margin of safety based off the quality of the business. Procter & Gamble's earned above average returns on capital in all 5 years that have been growing over this time. In a given year, Procter & Gamble earns about 18.8% average returns on capital. These are nearly 2.5 times better than a typical business. This is a big check on metric number 1. Metric number 2, we're looking for growth to go along with these high returns. We want to see growth in their revenues, net incomes, and free cash flows. All 3 have to be up for this to be a check. This metric's all or nothing. We'll include their numbers up until today in our calculations. In the last 5 years, Procter & Gamble has grown their revenues by 21%. Their net incomes or their earnings have grown by 47%, and the company's very slightly grown their free cash flows. Those are up 9%. This is growth across the board here for Procter & Gamble. Another check on metric number 2. Metric number 3, we're looking at Procter & Gamble like an individual shareholder in the company. We want to see earnings per share growth in the last 5 years. We just learned in our last metric their earnings are up 47%. At the same time, Procter & Gamble's bought back 6% of their shares. This is likely a good thing for long-term shareholders in the business. It depends at what valuations Procter & Gamble was buying back these shares to understand if they were creating or destroying value for shareholders. With their earnings growth and their share buybacks, this is a check on metric number 3. Metric number 4, we're looking for something similar. We want to see free cash flow per share growth in the last 5 years. Almost the same story as their earnings per share. With free cash flow growth and these share buybacks, this is another check on metric number 4. Procter & Gamble's perfect through 4 metrics. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Procter & Gamble apart, which is having these without using a lot of debt. Metric number 5, we want Procter & Gamble's net debt, which is their total debt minus their cash and their short-term investments, to be below the sum of the free cash flows they produced in their last 5 years. Procter & Gamble ended their last fiscal year with $25 billion in net debt. They've increased this somewhat. Right now they have $29 billion in net debt. In In the last 5 years, when we add up all of their free cash flows, Procter & Gamble has produced $66.5 billion worth of free cash flow. That's more than double their net debt position. This is a big check on metric number 5. Procter & Gamble generates a lot of cash flow and uses a modest amount of debt in their business. Procter & Gamble is flawless through our first 5 metrics. Do they have what it takes to be a perfect Select 6 stock? We'll find out right after we cover our bonus. As our bonus, we're looking at Procter & Gamble's dividend profile. Right now, Procter & Gamble pays an above average 2.42% dividend yield. Again, they're a dividend king. They've grown their dividends in the past 66 years. They've paid out dividends for 132 years. That's an insane track record. Even with a big yield and this long dividend history, we want to make sure Procter & Gamble supports their dividends using their free cash flows. That's been the case in all 5 of these years. They've grown their free cash flows per share and they've grown their dividend payouts per share. It seems they've also maintained a reasonable dividend payout ratio. While this is a snapshot of their last 5 years of performance, it's no guarantee for the future. Procter & Gamble seems to support their dividends, and they've done so in the last handful of years. This is a check on our bonus. The big metric of them all, metric number 6, we want Procter & Gamble's average 5-year free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this gives a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways we'll be estimating Procter & Gamble's fair value. Right now, Procter & Gamble has a $389 billion enterprise value. They're one of the largest companies in the world. Enterprise value looks at the business similar to it being a private company. It accounts for their net debt and their market cap. In the last 5 years, we learned Procter & Gamble generated $66.5 billion worth of free cash flow, meaning in an average year, they produce about $13.3 billion of free cash flow. When that's divided by their $389 billion enterprise value, we get a 3.4% average free cash flow to enterprise value yield. On a current basis, Procter & Gamble produced $12.2 billion of free cash flow in their last 12 months. When that's divided by their enterprise value, we get a 3.1% current free cash flow to enterprise value yield. Both of those are coming in slightly below the yield of the 10-year treasury, meaning they're down from the risk premium we'd be seeking. Coming in all the way at the end here, for Procter & Gamble, this is our first and only X of the day on metric number 6. Don't just throw this business out. We still need to estimate a fair value per share. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Procter & Gamble, which takes us on to using a discounted cash flow model to estimate their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Procter & Gamble has had a low degree of business predictability in their past. This affects our assumptions. We're starting with an average of Procter & Gamble's last 3 fiscal years worth of free cash flow. Then we're using historical assumptions to grow these into the future. It's up to you to figure out if these assumptions are accurate or not for the business. Assuming they grow these free cash flows at a rate of 6% annually for the next 10 years, then assuming in the following decade that these grow at 4% annually, we aren't adding in their tangible book value as that's likely skewed due to how the accounting is done for their share buybacks. If we're seeking a 15% rate of return, which is what Warren Buffett's looking for, from today's valuations, an estimate of Procter & Gamble's fair value per share is around $52. That's down a lot from their current stock price. This fair value is just about a third of that. Keep in mind some key points here. This fair value assumes Procter & Gamble stays at its current multiples that it's at now, 20 years into the future. Because of their low business predictability, this skews their assumptions. This discount rate is an estimate of their total returns to shareholders based off their free cash flows. It's already including their dividend yield. A 15% rate of return far outpaces Procter & Gamble's stock performance in their last 2 decades. Most importantly, this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. In just a minute, we'll give our final rating to Procter & Gamble, but we have to address something first. We've covered the numbers, but the qualitative aspects of this business may be even more important. What are they? Well, let's find out. Looking at the factors supporting a long thesis, number 1, despite reaching the end of its second $10 billion cost reduction effort, farther savings, likely stemming from reduced overhead and higher returns on its manufacturing footprint and marketing investments, could manifest if efficiency as ingrained in its culture as management suggests. Number 2, additional opportunities to narrow its product mix could enable Procter & Gamble to more effectively direct its brand spending to the highest return areas. Number 3, to the extent that retailers and consumers continue to find favor with leading branded operators, Procter & Gamble's sales trajectory may outpace expectations. But we'd be remiss if we didn't cover the negatives of the business as well. Looking at the factors supporting a short thesis, number 1, foreign exchange volatility may hamper profits over time since Procter & Gamble makes and sells its fares in different geographic regions. Number 2, consumers in some European markets are increasingly adding private label fare to their carts. Constraints on consumers' pocketbooks could incite a similar response on its home turf in time. Number 3, disruption to travel retail, around $1 billion in annual sales for Procter & Gamble, has plagued Procter & Gamble's beauty segment, which is 20% of their sales. These challenges may spring up again if mobility restrictions are reinstated. There you have it for a balanced perspective of some of the qualitative aspects of Procter & Gamble. Now it's time to give our rating. In analyzing Procter & Gamble, stock ticker PG, Procter & Gamble has a lot of the signs of being a wonderful business. They earn above average returns on capital, they've grown, they've bought back shares, they generate a lot of free cash flow using a modest amount of debt, they paid a dividend for more than a century, and they've grown a dividend for more than half a century. At the same time, they've supported their dividends using their free cash flows, and they've maintained a comfortable dividend payout ratio. It's worth reiterating this is not financial advice. However, Procter & Gamble doesn't look attractive compared to the yield of the 10-year Treasury when we look at their free cash flow to enterprise value yields. When we performed our discounted cash flow analysis, from today's valuations, assuming the multiples stay the same, using our assumptions and wanting a 15% rate of return, an estimate of Procter & Gamble's fair value per share is around $52. Procter & Gamble was last at those levels all the way back in June of 2009. Similar to Coca-Cola, you need to be very patient for this business. Looking at all the factors of our analysis, Procter & Gamble looks like a strong candidate for further research. If you enjoyed the video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Procter & Gamble, and let me know what business to look at next in the comments below. Thanks for learning about Procter & Gamble with me, and have a great day.